Welcome to this explainer. Today, we're pulling back the curtain on the hidden psychology behind candlestick patterns. Because, let's be real, if you've ever felt like the market algorithm is literally hunting your stop loss for sport, well, you're absolutely in the right place. We're going to decode the real story behind these charts and figure out how to stop you from falling into those brutal institutional traps. So, why do textbook candlestick patterns fail so often? Honestly, it's incredibly frustrating, isn't it? You spot a perfect bearish engulfing pattern, you enter a short trade right on cue, and boom, the market aggressively reverses on you. This happens day in and day out simply because the vast majority of retail traders are just trading the geometric shape on the screen. They are entirely missing the underlying psychology of the actual buyers and sellers who created that shape. To fix that, here is our roadmap for this explainer. 1. The retail trading trap. 2. Reading the battlefield. 3. The big momentum trap. 4. Reversals and price rejection. 5. Indecision and market consolidation. And finally, 6. The ecosystem. Section 1. Reading the battlefield. Okay, to truly grasp market psychology, we really have to redefine how we view every single candlestick on our charts. Think of a candlestick as a micro battle. It's not just some colored box. You probably already know the open, high, low, and close, but think about what they represent emotionally. The open is the starting gun. The high and low are the absolute extreme limits of greed and fear. And the close, that is the final stand. The distance between the open and the close proves exactly who won the war during that specific session. But here is where a massive trap lies. Time frame blending. Picture 3 consecutive 5-minute candles crashing downwards. To the naked eye, it looks like an absolute bloodbath, and panic tells you to short right away. But if you take those exact same trades and combine them into a single 15-minute time frame, the closing price often lands right back near the open. So what looked like a massive sell-off was actually just a totally neutral tug-of-war. If you don't zoom out to see the overarching psychology, you're going to get trapped. Section 2. The big momentum trap. Let's shift our focus to, arguably, the most dangerous setup on the board. You know exactly what these look like. It's that giant green or red candle that violently bursts out of a boring consolidation range. It absolutely screams breakout. But as our source material warns, these giant candles are precisely the zones where retail stop losses are hunted down. You see the massive candle, the FOMO kicks in, you buy, and instantly the price reverses. You didn't catch the wave, you just became the liquidity. So, why does this happen? Well, it's because big institutional traders purposely create panic to generate liquidity. They need a massive amount of people buying so they can sell to them, or selling so they can buy. By engineering an aggressive momentum candle, they basically emotionally blackmail retail traders into jumping in. This generates the exact liquidity they need to execute their own hidden orders in the complete opposite direction. And that brings us to a frankly staggering statistic. Trading blindly on these big momentum breakout candles without waiting for further confirmation, it has a dismal success rate of just 1 in 10. Yeah, you heard that right, a 90% failure rate. Chasing the shiny giant candle without understanding the institutional psychology behind it means the mathematical odds are entirely stacked against you. Section 3. Reversals and price rejection. Next up, let's explore what happens when price is violently pushed back. Let's talk about the liquidity sweep. Imagine prices dropping toward a major psychological barrier, let's say the 55,000 mark. Everyone places their stop losses sitting just below that line, right? Well, the market will frequently dip intentionally below 55,000, purely to trigger all those stops, sweep up the buyer liquidity, and then aggressively reverse higher. That long lower wick left behind isn't just a shadow, it's a scar. It shows exactly where sellers pushed hard, but completely failed to hold their ground. So how do we actually trade this safely? The ultimate secret here is patience. First, you want to spot that long lower wick at support. Next, watch for shrinking candle sizes leading up to it. That's a really clear sign that sellers are losing steam. Now here is the absolutely vital part. Do not enter immediately. Wait. You have to wait for a definitive green candle to close completely above the previous red candle to prove buyers actually took control. Finally, tuck your stop loss strictly behind that long rejection wick. That wick is your structural shield. Section 4. Indecision and market consolidation. Now let's decode those highly frustrating moments of gridlock. We usually know these as indecision candles, or dojis, where the open and close are virtually identical. You've got long wicks on both the top and bottom. But remember, context is everything. When you spot these specifically at the end of a very strong trend, it's a blaring warning siren. It signals a drastic drop in volatility and total market confusion. Sometimes the psychology takes two back-to-back opposing candles to play out, but the message remains exactly the same. Pure, utter indecision. While you're watching this gridlock, pay really close attention to the candle bodies. Shrinking candle sizes leading into a consolidation zone mean fresh participants are losing interest. There's a severe loss of momentum happening. And here's the golden rule. When momentum dies in a consolidation zone, the probability of fake breakouts absolutely skyrockets. This is the ultimate difference between trading the shape and trading the psychology. If you just trade the shape, you jump in the second you see an indecision candle, and you'll likely just get chopped up inside a chaotic consolidation zone. Trading the psychology, on the other hand, means recognizing the confusion, literally keeping your hands off the keyboard and waiting for a definitive, strong candle to close completely outside of that indecision area before you make your move. Section 5. The ecosystem. Look, mastering this psychology is absolutely non-negotiable for serious traders. But the broader trading ecosystem also offers tools to bypass some of this heavy lifting. For those of you working full-time who genuinely lack the hours required to analyze every single fake out live on the charts, our source material notes that platforms like the Univest app exist to help bridge that gap. Tools like this provide SEBI-registered analyst recommendations, real-time alerts for precise entry and exit levels, and even automated stop-loss tracking. It's a great way to ensure you aren't flying blind against institutional algorithms. But ultimately, whether you use automated algorithms to help you, or you read the raw charts yourself, it all comes down to this. Tomorrow morning, when you pull up your screen, leave the textbook shapes behind. Look at the chart and ask yourself, are you just trading a geometric pattern, or are you finally trading the psychology of the predators on the other side of the screen? Remember, master the psychology and you stop being the liquidity. Thanks for tuning into this explainer, and I'll catch you in the next one.